thank you everybody for joining with us tonight. The agenda is today, and we'll spend about 5 or 10 minutes, around 10 minutes or so, to talk about who we are and how do we partner. And then we'll spend most of the time today to talk about the risk and a little bit more academic way of taking a look at the market risk and the project risk. I'll spend a little bit more time on the market risk project. If we have time, we'll talk about it. And if we don't have time, then we'll have another session. So I kind of marked that project just to kind of share. Full disclaimer, it's going to get a little bit technical, so kind of bear with me. I'll try to take you guys and give you some context and some fundamentals about what the technical definition of risk from the academic perspective and how some of us take a look at it and how those play into multifamily, especially in the larger assets, and also the market dynamics. That's that. And again, if you have any, if you're joining from home, have your Google open as you talk through it. You can also might want to Google and ask me all the questions you have, and some of them I may know that I will try to answer. And if I don't know, I'll let you know I don't know. I will look back with you down the way, and then we'll have the Q&A session. And after party, just a full disclaimer, hang out with us. I will share a couple of things that we use or I use personally to keep me sane when we look at the market. And those are interestingly, they played out well for us. And also those are some academic way of looking at the market as well. All right, so today's, where we at? Cool. So this is us, and I updated our one more person, Angela. She's on there. Mike, I didn't miss it this time. Last time I dropped the ball. So we have, hey, Sanjay, you here on the call, or he's driving?
He's driving. He decided to take off. So Sanjay spent the afternoon with me. I think the morning with you in Pasadena. We spent the afternoon here in Houston at my place, going over some stuff, finishing up a final proposal LOI on a property in Dallas. So, and then he just headed back around 5 o'clock.
And then he also walked the assets in Pasadena that we have, and we walked the site, and we had some roof replacement, water conservation going on. So, and the asset looks much nicer, and so we are working on that one as well. Okay, so Sanjay is driving. And this is me, I'm Shariah, corporate background, come from Shell, for 15 years of Shell, 6 years as an engineer, and the remaining 8 years or so roughly on the finance. So that's that. So I will play out, I'm gonna wear my finance hat today. And we have Mike, the CIO, and we have Trevor, and Jen may not be here, I haven't seen her. We have Jasmine, and I believe rest of the team is here, right? Sorry, guys, I'm working on both screen. If I don't see you guys, please let me know. So I appreciate all of my team members for all the things that they do behind this scene. Okay, and our skill set, what we do as a massive capital as a team, we buy land for new construction. Also, we do value add, and across 6 different states that we have, location where we don't have footprint, we partner with local operators and also local developers to bring in the skill set that we have. Almost all the deals that we have done, it's a skill set first. We put the team together where we have the skills, less of a learning, more of a doing, and then we go after the project to make sure that project risks are mitigated. We'll talk about that today. So last year we finished the year. So this is our month number almost 12, right? And we finished the year 2022 with $106 million worth of asset. Those are the markets that we are in green and light blue is the markets that we're looking for. And also we have 3 properties under contract. Again, this is open at a conversation. This is for educational only, not pitching a deal, anything like that. So full disclaimer, we have a couple of 506B that we're not going to talk about it. So it's just there for the record. Okay, and how do we partner? We have typically, for most of the deal that we have done, we bring in the loan. We also bring in the earnest money, also bring in the asset and asset management know-how, depending on the size of the project. So we are partnership heavy, and most of the deals that we do, we underwrite the partnership team, the skill sets and the know-how, and then we put the deal together, which is a little bit atypical compared to the other valuation model. When we put the project first, then go build the team second. We flip that backwards, it's team first, market second, project third. So project is always the number 2, number 3. If the team is the first one, that's because for us perspective, we don't buy properties, we buy risks. And our goal is to mitigate the risk as much as we can. What we have done last year, we have done 21 people become GP with us for the first time. Our goal is the same. And we tend to behave like an accelerator platform for operating partners and equity partners. If someone thinks, if a team believes they can buy one property or two properties, then whenever we partner with that speed, kind of shows up, and also the size shows up. And the same for the equity raisers. We partner with equity partners where we ask them to underwrite us, and we take on the the time and the effort to deal sourcing and due diligence asset management, so they can really focus on what they're good at, which is building relationships. So, deal flow. Go ahead, Mike.
Hey, let me jump in just while we're talking about partners and getting to know Massive Capital a bit. Is if it's your first time here, just drop in the chat first time, and Trevor, Jasmine, Maria will share their contact as well. Reach out to any of them to learn more about getting to know Massive Capital, how to follow up, partner with us in any ways, whether it's an LP or bringing a deal, or whatever capacity that you think you might fit or want to fit. Connect with one of them, Trevor, Jasmine, Maria, Candace, anyone else that was on the list, on there as well that you saw before, and just connect with us. So any first timers, let us know who's first time. We'll try to connect with you, but also follow up with us. So just wanted to throw that out there, and I'll let you go ahead, Sharpe. Thanks.
Thanks, Mike. Yeah, please reach out to us, and happy to share. We tend to be a little bit more flexible. For us, deal making, it's an art. It's not, and it's art first, science later. While we say that way, so think about us as four partners. We have closed over 400 properties in the last 5 years across all asset classes. And so we have a little bit of know-how and some of the burns that we have had. So we tend to be a little bit more flexible, and we try not to be the same way of cutting the deal all the time. So please reach out. Okay. So we have our deal flow. I love this screenshot. I like to keep it steady. It gives me a flavor of how we're working. We have 3 properties under contract, 4 LOIs pending. I believe it's 6 now. We have 18 assets in the pipeline. We have a fund that we're working on. It's ready. Once you find the right asset, we'll start. And so again, we are continuously looking for opportunities. And Mike, you can talk a little bit about the mentorship program. That's TBD, I guess, right?
Yeah, it's we're finalizing it out. We have a couple people that have joined us in Massive Capital that we're going to be rolling out the mentorship plan with, and you'll start seeing it a little more advertised. Currently, there's a few opportunities with just the Deal Doer machine that you can participate in, which basically gives access to Red IQ and some off market opportunities, direct to seller type of a way to look for deals with the CRM, and a lot of deals or potential deals loaded into the CRM that come from Reonomy and CoStar. So those are a couple things, and then we'll be rolling out some newer stuff based on all the activities we do on a regular weekly, daily basis, from our deal review rooms to our capital raising calls that we do on a regular basis. So stay tuned.
Thanks, Mike. So on that note, I mean, at the core Massive Capital team perspective, we do deals, and that's our goal, and that's all we want to do. As a part of that, we work with a lot of folks, and it just made sense. So we're not an educational platform per se. We are doing platform, right? We are the applied education per se. We can study the theories, go to the YouTube University, then time comes to take action and roll up your sleeves, get to the calculation. That's where we fit in the best. And you'll see that flavor of coming in as you kind of go. So we have Thompson, Trevor, you want to give us an update on this one? Where we at?
Yeah,
it's a 506C, right?
This is our deal. It's a 506C new development deal, 10 acres in Georgetown. It's a land entitlement, which means we're buying the land and getting it entitled for phase 2, which would be building it. We're actually have about one spot left. If you're interested, you need to reach out real quick. We're going to be wrapping this one up by Monday of next week, and we're very excited to get that one closed to get going.
Thank you, Trevor. And this one is top secret. We can't really talk about it. It's a 506B, only time if you know each other. And hey, reach out to one of us as you go through. I don't think so we can get you into this still because first time we can't, but the build up the relationship is very important. We also have another 506B again. It's another top secret. The only time we can talk about it once you know each other, right? So hey, reach out to us as you go. All right. All right. Again, this is gonna get a little technical, so bear with me a little bit. And we're gonna go through some finance theories and some definitions on it, and we're gonna go. So hang tight. And if you have questions, just drop it and I'll drop it on the chat box, and I will try to answer as I go through. Just gonna go. Okay, it's a lot, but let me kind of take you through. So what we're trying to do is that, it's we do buy apartments. It's simple stuff as you take a look on the surface, but sometimes when you get into the higher ticket item, it gets technical, right? And then we have to understand what is the risk. And the definition of risk, we have our own perception of risk versus the book definition, right? So here I will try to use the book definition. I'll give you some context about why the definition is as such and how do we measure it, so that we have a unit of measurement. So when we go into an asset, we kind of sort of know what that return would look like because I am managing a risk, right? So for everybody who loves politics, we got modern portfolio theory versus modern monetary theory, right? This conversation is based on the modern portfolio theory, which is, in a simple word, we need to balance the balance sheet. And modern monetary theory is the other one, which is the left sides, Barney Sanders of the world. They're going to say, hey, you can print the money, and it's just me printing the money for me, so it doesn't really matter. You don't have to balance the balance sheet. So, but this conversation is the modern portfolio theory. That means whatever we do has a consequential impact to it, and we have to balance the risk associated with it. Based on that, the definition of risk is just the degree of uncertainty, right? Or that potentially could down to a loss. So you have a downside and you have an upside. Understanding that is the risk, right? And based on what we do typically on a day-to-day basis, and I'll give you 3 high-level units to measure, which is those 3. We call it beta, Sharpe ratio, and alpha. So think about stock. Every time we buy a stock, the first question we should ask, what is the beta of the stock, right? And beta means that my performance based on the market. Market means that S&P 500, right? So we tend to say S&P 500 is 1. That means, if I roll whatever my S&P 500 will give me the return, that is my 100% of the return. That's my baseline. And beta is the benchmark against it. Example, Shell has a beta of 0.9. That means if the market makes 10%, then I have Shell, which is stronger than market, so I should get 9% return. If I buy Shell stock and gives me 9% return versus the index fund gives me 10% return, risk adjusted, I'm in a good spot, right? So that's the beta is. If you have a stock, it'd be interesting for you, go take a look at it, what the portfolio beta looks like. It is really cool way of measuring the volatility of that. Sharpe ratio, beta, this lower is better and more than 1 is worse, right? But that's a choice that we make. At some point, when I was back in the days, I had part of my portfolio 0.8 and part of my portfolio is 4.0. So I managed it as we go to kind of measure the risk. Sharpe ratio, again, this is a measurement against the risk-adjusted return, which is a bond, right? If you take a look, that in a lack of better words, in the bond market, whatever the rate is issued by a larger institution, Feds or the state, you benchmark your performance against that. So most of the ETF, they will start with the Sharpe ratio. So whoever does trade here for the ETF, it'll be kind of cool for you to take a look, what is the Sharpe ratio for your particular ETF, then you stack them all up and see what the aggregated ratio looks like. Last one is the alpha. The alpha is that, it's a risk-free return. It's a measurement of return compared to the benchmark. So typically the way we use alpha is that, am I getting a better return compared to the risk that I'm taking? In other way, if Shell stock is 0.9 and market is 1, right? I'm going to use the same example. If Shell gives me 10% return being its 0.9, that means it's an alpha stock. It is giving me more than what I'm supposed to get. So I do the same amount, I take the same amount of risk, but I get a higher extra return. And that's like a really alpha. So we tend to go for the alpha products by managing the beta. And that's how we take a look at the technical risk. So it's a lot, it's a mouthful, but I know you can share this video, but typically risk is beta, alpha, and Sharpe ratio. That's how we take a look at it, right? Why worry about the risk? For us, it is high risk, high reward on the high side. On the low side, high risk, very, very low return, right? And also the cash flow. It is a risk because in each of the product that we do or projects that we do, it has an associated risk for the cash. We believe to survive in the business, we must have cash, either in our pocket or from the project, whatever the case might be, right? And money will always run out. So putting the projects in a good spot and balancing the projects which has less cash flow, couple that with the more cash flow, couple that with the big bank cash flow coming up. So all those things, it's a portfolio risk that we take a look at it. And this is the last one, is that for underwriting, follow the model around. Anybody went to B school, you know about him. He's a professor of Starnes School of Business from New York. He's one of the best modeler of the country, would say. And he has some cool stories. Study him if you want to really know underwriting at the high ticket items, right? On the right side, this is a baseline that we use for academic study. Like if you go to school and we say, hey, we're going to start a model and we're going to compare risk based on different segment of the business. Assuming the S&P 500 is 1, you could take a look. Real estate is typically lower, 0.79 versus the market. Another way, if market goes crazy, then real estate in general should get less crazy, right? REITs are pretty at par with it, and the development has a higher risk. So by design, if we do all things equal, if we do a development project, expose ourselves to higher risks. So mitigation of that risk has to be much stronger than buying an existing asset. And the risk will be a different way, right? Development has risk. What's going to happen 3 years from now, 2 years from now, you're betting on that. Versus on an existing asset, we are betting on the operations of it. Short-term exposure versus long-term exposure, right? It's a different kind of risk. So that keeps us in line that as we take a look at it, what is happening. And as we do those projects, our expected rate of return should be much higher in a development project compared to an existing run and maintain asset, right? So that's the typical definition that we're going to use. It's all about the risk-adjusted return. It's almost like sometimes jumping from a 6-foot wall is much more dangerous than jumping off of a plane with a parachute and a right training. Even though jumping off a plane with a parachute or right training sounds scarier than jumping off a 6-foot wall, right? So this risk is just like that. As long as we are tactical about it, we have a decent idea how we go about the risk, we put some boundary around it, then we go and play. Okay? I gave you guys 2 years of the theories in 10 minutes, so hey, it's gonna be fun. All right, now we are gonna talk about a little bit more about the market risk. So there are 2 kinds of risks we're gonna talk about. One is the market risk, one is the project risk. The market risk, what happens at the very macro level, and the project risk, what happens at the micro level, right? And then we're going to talk about it. So think about the multifamily. It's up until it's like a 2 layers from the market to the location, and to U.S. economy and the location. What happens to that, and also then what happens to GP team and below it's a project and a GP team, right? I'll start with the right side of it. Let me walk you through a little bit. Right side is a typical chart that we do. Number of stocks will be number of projects. And this is the portfolio risk, which is the total risk. The systemic risk or the market risk, that means just because we are in the segment of business or just because we're investing, there's a risk. There's nothing, it doesn't matter who we are, where we're from, how much money we have, all of us are exposed to that systemic risk. Interest rate hike, right? That's a systemic risk. And there is nothing we can do. I mean, typically the risk right here, the definition of systemic risk is the breakdown of the entire system. And that just simplifies the failure of the individual parts. It doesn't matter how.
Are you muted or you went quiet? frozen. Oh, he's frozen or unfrozen.
And looks like he turned his lights out too.
Regulation. I didn't. Go ahead.
Hey, Schreier, you froze for about a minute there.
Oh, sorry. What did I lose, everybody? Okay, I'll start with the system.
Minute in time.
Oh, damn. Okay. All right. So I'm going to start with that. I know the definition, we talked about it, and the market risk that we talk about here. It's market risk, or we call it systemic risk. It is cost of or risk of doing business, right? Just because we're in the real estate, if something happens to interest rate, independent of what location we do, what asset class we do, what property type we do, that cuts across everybody. That's the risk, right? If there's economic downturn, that's a risk. Supply and demand, there's nothing you and I can do. It's a risk, right? The systemic risks or market risks are mostly unavoidable, and you just cannot, reduce it by diversification as well. Like location versus price, it doesn't quite make sense, right? So, case in point of interest rate, then we also have a downturn and also have a natural disaster, right? There's nothing you and I can do if the Russia war escalates, right? If China decides to take a position, if India decides to take a position, escalate the whole war, there's nothing you and I can do, but we'll end up paying the price. And that is called systemic risk. And we'll talk about at the end, how do we mitigate, or when we get to a place where we have systemic risk, what does it take for us to get out of it, right? But the point is, understand, we may have invested in those projects where buying in price was good, execution of the process of the business plan was good, but happened to be we're here now and it's time to sell, and return went down. So from the investment perspective, it's nothing we can do, it's market. So as investors, both on the LP side and the GP side, we should be comfortably about talking about this and say, look, what inherently systematic risk is out there. And nature of the beast. We take ones and twos, we try to hit those home runs, but ones and twos, sometimes ones and twos will be zero. That's because not of us, because of the macroeconomic condition, right? So that's there. And on top of that, you couple that on systematic risk or your project risk. We'll talk about that as we go. But the point is, systemic risk or market risk are mostly unavailable. It's here. Those are tail end risks. We try to play with it, but reality is we can't, right? That's that. Second one, we call it idiosyncratic risk, which is the unsystemic risk, which is the risk that we are in control. Now it gets funny. Most of the conversation that we do, most of the underwriting that we do, it's here. So from the multifamily investor perspective, let's take out this idiosyncratic risk into two ways. One, it's on the GP side. One, it's on the operation side. We tend to talk mostly about the operations. We don't tend to talk about mostly on the, we don't tend to talk about the GP side. So I'll give you on the both side of the idiosyncratic risk, right? So on the chart on the right, it is a version of the previous one, systematic risk and unsystematic risk. So what we talk about here, the unsystematic risks can be eliminated or reduced by diversification, right? What I meant is that as an investor, we should invest in developments, couple that with the existing asset, invest in C, couple that with the A or B, invest in Texas versus Colorado versus Carolinas versus Phoenix, because each of the location has their own style and own different kinds of risks. So as an investor, you should always think about investing in, throughout the portfolio. So by the sheer number of the different types of projects that you have, your portfolio is in a balanced mode. So that's one way, right? And then going back to the risk, right? Some of the risks that we have on the operation perspective, which is the operation strategy. What if we have a cost overrun? What if we have a back execution? What if we could not manage the project right? Which is that we typically talk about, right? And then we also have the investment strategy tips. Number one, we talk about is that sometimes investment hypothesis is wrong. It's like, as the inflation was going up, and we took, if someone takes a position that I'm going to go after a triple net asset when inflation is high, that's a subpar investment hypothesis, investment strategy during the time of inflation. Because academic perspective, we should get into the projects where we have pricing power when the inflation happens. So as the things goes up, we can change the pricing as you go. Thus, we should not buy asset that has a 10 years cash flow fixed with 2% versus inflation is much higher than that, right? So investment hypothesis is the big one. Then financial policy is a big one, because here that's where the team comes in. If you don't have enough working capital, if you don't have enough liquid funds, if something goes sideways, we have to do capital call. Is it the LPs bringing or the GPs bringing? Not talking about that early on, not having a good financial policy within the project team, that's a risk. Then operating strategy, it's a risk. Then also the corporate culture management style. It's that how do we manage the property management companies, and when we have one project versus when we have 5 projects versus when we have 10 projects, right? Does the GP team have enough time to manage that? Do they have a back office to manage that? And those are the risks that we have on the management style. And the last thing is the people risk, right? What happens something, God forbid something happens to me tomorrow? What happens to all the projects that's happening, right? So that people is always a risk, right? So the change in leadership is a risk. It's a style change that has an impact to the project. So those are some of the idiosyncratic or the project level risk that we have. And when we underwrite it, and from asset tip perspective, we always talk about underwriting the GP team is the first thing we do. Underwriting the GP team who is running the assets or calling the shots for property management thing is one of the biggest focal of underwriting. Then we have rules around the financial policy. It's that our GP team's net worth should be at least 2 or 3x of the loan that we're going to take. That gives us the strength that that team is going to stick around for 2 deals and 3 deals or more. We also have a financial policy where we said that at least 3 months of working capital should be vetted by or should be paid by the GP team who are doing the deal. Otherwise, it's too skinny, right? Imagine we're running a $20 million deal, working capital is 150 to 200 grand a month, and something happens. One of the check from the bank is becoming 3 months late. What happens? Who's going to foot the bill? If the team is not there, if you don't talk about those tough scenarios or weird cases, at least have a plan around it, it becomes problematic, right? And the last thing, we also talk about the people risk. Everybody gets hit by a bus at the end of the day. Then we bring it back up again. So it's a weird way to making sure that we deliver the project as we go. Now, having said all, it's a risk management that we do. It's an interesting way to balancing on the risk with the mitigation, but life happens and it happens all the time, will happen all the time, and we'll take one thing at a time and move that forward. But being upfront about it, being open about it, and talking about it as much as we can openly, that's a healthy relationship in both on the GP team and GP and LP team. And from the LP perspective, we should take a look at that. And you should use this kind of a lens to analyze the deal as well. All right. Last thing, how do we usually manage those risks? On the market risk, we try to lock in the interest rate wherever possible, right? We just try to stay. Last year, when the rate was going up or the market was going crazy, I remember we had a heavy debate. And from the finance perspective, we thought Feds are going to do 3 things. It's that speed of rate increase, height of rate increase, and longevity of the rate increase. We didn't know any one of them. So we decided to take every debt at a fixed rate. By design, it puts us on a recourse bucket and puts us on the small assets. So from April, after our first asset, till about June or July, we bought a bunch of small assets. But guess what? I had fixed rate. We signed on the debt. It was okay. When market flipped, that means how fast it's going to go up. We're already done with it. How high it's going to go. I think we're on the very tail end of it. Now the question is how long it's going to stay. We believe it's going to stay for longer. That turned us and saying that take loans that is closer to the market debt. That means we'd like to pay 9-10%, or would like to buy projects that will allow us to pay a 10% interest rate. If not, new debt. And then if not, a loan assumption. Versus most of the deals that you see today are loan assumption, right? So again, we cannot mitigate that, but we want to try to stay close to the market. So when the thing goes sideways, with our portfolio, we go sideways as well, but a little bit less than others, right? And the last thing is be patient with time. Fullest thing about real estate, being patient, it's extremely important when things goes wrong. And being patient is possible if we have staying power. That means if you have cash flow. That means if you have cash somewhere else, right? So being patient, having enough cash, staying close to the market debt, locking interest rate as you go is a proxy for us to stay close to the market, knowing that we cannot avoid if something were to go wrong. And the unsystemic risk or idiosyncratic risk, we diversify across asset categories, asset property type, and location. You'll see us going back to our first portfolio. We're in 6 markets. We buy land for new developments. We buy Class C value adds. We also buy Class A properties because we believe we need to do those projects all together at all time to create diversity in the portfolio. We use technical information, which is semi-public. We'll talk about it in that and other half of it. So, what we see may not be the truth at all times. You have to go dig in 1 or 2 layers deep into it and then use those information as you go. We have established financial rule that we do, and we typically keep a high reserve, and we have people plan. We have an idea if something were to, if Sanjay is the lead for a project, something happens to him, we need his time somewhere else, then who's going to take over? So we have backup plans at all time as we go. Same thing, we have backup plans for property management companies as we go, right? We're always looking for a leading indicator that's going to tell us, hey, 2 months out, 3 months out, that property management company got to go. So what's my backup plan? So we tend to talk about the backup plan all the time. So that's our usual mitigation. So, and I went through rather quick, but I want to open up the Q&A as much as we can. So here we are. I think I met the time. Okay. All right, I'm ready. Let's bring out some questions.
And sometimes if you just don't present, we can see everybody. Just raise your hand.
I know you guys have questions.
You must have done such a good job. Nobody has any questions.
No, I went like this. Risks are fun, When you think about, like, as the question comes in, right? The reframe, frame the question. We don't buy properties, we buy companies. And our GP team is our C-level team that we're going to hire from the LP perspective to execute the business plan for 5 years. That's a simplistic way of looking at it. And you'll see how risk will show up, right?
Someone asked about GP partnerships. If you could talk a little more.
Sounds good. I like my secret projects. So, for us, we do partner. So we have 2 typical different kind of partnerships, right? One partnership with the local operators and other partnership with the equity partners. When we partner with the local operators, again, we tend to be an accelerator platform. We'll underwrite the team. We'll let the team underwrite us. And whole idea is that we want to grow that relationship value to an X dollar amount. So we ask the question, okay, hey, local operating team, how many assets you have purchased? For our definition perspective, nobody's local unless you own an asset wherever you are. Example, I live in Houston for 23 years. Based on our definition, I'm not local Houstonian if I don't own any assets. So unless we own assets, we're not local. So when we call a local operator, it's first really, do you own assets? And then from there we start, right? And that's how we partner with the local operators. Our goal, again, to build their brand, to help them grow the operations, and kind of deburden them from the debt and equity that we come in and help. So that's one partnership. And the other partnership of the equity partnership perspective, often a lot of folks will raise equity, but they have to source the deal, know the team, underwrite the deal, underwrite the location at all time. For us, we take everything on that, we take those stuff out of their plate onto our shoulder because we're doing deals already. And we want them to underwrite us, how we think, what we do, and our process. Once we establish that, next partnership is easy, right? And that's how we go about it. And that's how we went into all of our partnerships.
Awesome. Victor?
Brooke's question. Brooke. That's like a 2-day session, right? And I'll try to give you an answer at the high level. Sorry, Trevor. You something?
Yeah, great information. I love it. And it's always good to learn on other people's point of views, right? Because everybody does everything differently. So whenever you take down an asset, you always have like a 3-5 year plan to try to keep and stabilize it. So what would happen if your let's say it'll be better to get out early. How would you go back and talk to the investors and make them understand it's going to be a better return that way because it's a shorter period?
Got it. So I'll give a long-winded answer. Typically, when we take a look at it, we solve our investment in terms of NOI. We have a target NOI. The moment the target NOI gets triggered, we take an action, right? And our goal is to exit. And we buy today to sell yesterday, if we can hit the NOI. For that, we model for 5 years, plus minus 2 years. As long as we're closer to the NOI, and then we kind of go. And that's our baseline. And we're open. All of our underwriting assumptions are pretty same, 5 years, plus minus 2 years. But we model everything on the 5 years. And let's see if we bought something now, market accelerated much faster than us, and we believe we have a better investment to go to, or it's time to get out because we cannot get any more added value out of it. We'll just make the decision as we go. On that note, us, when we run the asset, we GP team decide. We don't ask for the voting. What happens is, think about last year, we have 144 investors with us invested, and getting all 144 into one page, it's going to take 5 years to get there, right? So we said, for us as an operating team, our promise is to give you the return, and if that shows up our lead, then we'll execute on it as we go. But before that, we communicate. We don't keep anything on the back burner of it.
Yeah, and that the best thing about it, you're able to go ahead and basically cash out the investors and say, hey, by the way, I have another project for you if you're interested. So you're kind of piggybacking everything to it too, right?
Yes. That happened before we started Massive, but now Massive is a brand new company, right? Almost a year into it. So we're in a buying mode. We are keep buying it as we can. And some of the projects may go before we think. And then for us, our conversation to all of our investors is take shots, ones and twos. Don't wait for one, then take that to another one. It's just a linear process. It takes a long time. Every 5 years times 4. By the time we do 4 deals, we'll be out somewhere else. So take turns, and then to put your investments a little bit at a time, but spread that out so that you can balance it out, right? And yes, if that were to happen, take the money from that project, go to another project. Absolutely so.
All right, beautiful. Thank you very much.
Let me see. Can you advise on beta Sharpe?
Alex?
Go ahead, Trevor.
Hey guys, the information, it was good, really good. So the question that I have is, it was very clear to me that local partner means that it's someone that is local and also that owns an asset, right? So but my question is there a minimum amount of units or maybe assets that you guys needs, or that person needs to have experience with?
Got it. Local means you own assets. You don't have to be physically local. For us, I could live in Seattle, buy assets in Texas, or if Alex says you live in Seattle, you buy assets in Georgia. To us, you're local to Georgia because we own assets, right? So it's not physically, you don't have to be there. That's one. And back to the other question is, what's the size? So what we do is we look at, for us, we're flexible, right? And what is really drive the relationship and the conversation is the quality of the partners. And I'll give you an example of North Carolina. In North Carolina, we have 2 partners, John and Bobby. And think about them, Barclays MBA, Thunderbird MBA. They run 150 people in the organization. They ran $15-20 million of the portfolio by themselves. And they have 1 property there. They have a bunch of single family. They have 1 multifamily and for $1 million. We bought them and we partnered up because we saw the strength of the relationship, the quality of and the caliber of the 2 of our partners, and they lean into full time. They said, "I'm having W-2, but I'm walking towards a path of full time." All of a sudden, we said, makes a lot of sense because we need 2 full time, CEOs, CFOs, and COOs to have a portfolio of $20 to $50 million, right? At a $50 million portfolio, we need our C-level team working at a full time. We don't want to partner with somebody who's, we'd love to, but statistically, if you work 60 hours in a W-2 and you run 5 projects, you don't have time. You just don't. And you could be a rock star, but you just don't have time. We have 24 hours, right? Nobody works at nights and weekends. They got a job to do on a property management, right? So that's why we say, hey, if we tend to work with local operators who are full-time or working into the full-time mode in the real estate, and they have a stronger background, and so that we don't have to really hang tight on the unit count. So they went from a 12 units to 31 units to right now we're making offers and $15 million assets, $12 million assets within less than 6 months of the partnership, right? So yes, we are flexible, but it's the background of the partners and the willingness to work in a space tells us how we kind of design the partnership.
Perfect. Understood. Thank you so much.
Awesome. Vivi?
Hi. I would like to know, let's assume you have a property and you told your investors you're going to return their money back in 3 years. And come 3 years, you're able to return the money back, everything, good returns and all that, but you don't want to dispose of the property. What do you do with those investors?
Got it. So it's cool. That's a very awesome question. For us, we don't have that issue because we believe we are deal makers. We believe there are plenty of deals to do. So one deal keeping or living it doesn't make a difference in our portfolio. So if we were to sell, we would sell, get out from the investors. Or if we were to keep or asset makes sense, it's just cash flowing, we'll just ask investors, is it okay for refi, right? And then we'll decide where to go. So I don't think so we'll be in a place where we would like to keep something, we want to take the investors out. That's not the framework that we use when we talk about it. So for us, we are with them all the time, which is also, and that's also why every time we do a refi, we don't change the ownership split. We keep the same ownership split. Like, the waterfall may change a little bit, but we lock in the money as they come in up front. We don't refi and reposition at all.
Oh, okay. Because I know some people do 50-50 at that point.
Yes, we'll do 50-50. Waterfall changes, but that's after we make you whole because the risk was taken. We'll do it. But if we do that, we'll talk about the way up front. We're not going to come in on the tail end of it and change the what we have. Yes. So let's see, one of our projects, we're doing a 50-50. That's because we believe it's a little more intense project and we can do more. Since this is the intense project, our investors come first. We'll get them to a target. And then if we promise to, if we have delivered what we have promised, we get a bonus on the tail end of it. We're putting the money where the mouth at, right? The very tail end of it, but we are upfront about it.
Okay. Thank you.
There's a question in the chat from Tracy.
Okay, understand that you can. Okay, let me show the screen. Minimize the product by diversification for market. Okay, all this need relevant skill set, expertise, whatnot. Yes. Oh, thank you. Thank you. Awesome question, right? So let me give you my answer of it. In general, if I think about the risk, I want to bucket it, right? So at the very end of the bucket is the operational know-how. Operational know-how comes from the local subculture where the property at. Every zip code, every state got their own subculture to it. And we must understand the subculture to do it, right? As we all know about it. That subculture doesn't come on the financial study from far away. That's why having a local operating partner is very important. So that's the mitigation of the first risk. We don't get into a location where we don't own asset as a team. 100% of the location we got in, we had assets or our local operating partner owned assets. So we know the subculture. We have Rolodex where they know the different vendors and everything else. That's one. On the very top end of it, US is our marketplace. We have our own internal semi-proprietary calculation that we took all the data from the US by the county, by the US MSA county. Then we added in last 12 years of population growth, job growth, population growth, adult migration only, job growth, revenue growth, bunch of other stuff. Then we force ranked it. Once you force ranked it, we have an idea in which of the states comes out stronger versus the others, which of the counties comes out stronger than others. We use that as a guiding principle to go to the asset. That resulted going into all those markets simultaneously. So yes, on the finance strategy, on the top, very top on the far away, we do some technical analysis that we have done already. That showed us which way to go. Then we couple that with talking to advisors. We have 4 advisors. Numbers is just outrageous. They have been all those markets we have been. So we just asked the question with the slide, hey, what do you think about those markets based on your assets? So we took that study, we tested with that, realization of the existing or actual performance. So we locked in those markets as we go. So those are the 2. Yes. So yes, we are finance heavy. That's why we are flexible to learn everything. We can give you a quantitative understanding in terms of the difference between the Colorado market versus Carolinas versus Dallas versus Phoenix, that kind of stuff. And last one is the operation. Okay. That's how we resolved everything as of now so far. Good question, Tracy.
Thanks,
Yes,
Shula.
and yes, go ahead,
Thanks,
please.
Shula.
It's a very good question though. Just to kind of give you if you one of the things that worked for us, we played as a team. We bolt on to each other's skill set. It wasn't Schreier trying to learn everything about everywhere, about everything, about doing all those things, right? We believe multifamily is a team structure. You got to play as a team. You got to take your skills, bolt onto the others, and make it stronger, right? So we have been fortunate where the team came together and we brought in our individual skill set, and when coupled that all together, it became even nicer, right?
Hey, Schreier, just jump in real quick on a couple things.
Please.
For Jasmine, just want to be sure we want to let her get her
Yes.
shout out and be sure to talk about her and her team. At the same time, I want to, before I turn it over to Jasmine, I'm going to post again in the chat. If you are if you want to be, working with us, be an investor, partner with us, we are changing portals, and we're going to be using cash flow portal. I'm going to put in the chat the link to sign up for cash flow portal for our portal. Please jump in there, get signed up. We'll be moving people over from the other one. We'll be moving our deals over, but all new deals currently will be coming into this new portal. And it'll take us probably about a month to get things shifted over as well. So just want to let y'all know ahead of time that it's coming, and go ahead and sign up. Even if you're not investing today, get signed up. That way you'll start seeing deals as they come out. You'll see the deals come out. You'll see them in the portal. You can review them, check them out. Details will always be there. So I'm going to drop that and I'll turn it over to Jasmine.
Yeah, thank you so much, Mike. Yeah, so we created a Massive Capital Girls Society. This is just a place for us to grow personally, professionally, spiritually, but also create generational wealth, empower each other, support each other, and just share with you. We've been hanging out with this gentleman for over a year now, so we want to share with you everything that we have learned. Along with all our mentors, Grant Cardone, Brad, Sumrock, Radcliffe. So yeah, we just want to open up this space for us, and hopefully you guys can join us. And I'm gonna drop the link here on the chat, and also if you can scan that barcode, the quick QR code, it will take you there. I don't know if any of the ladies, Maria, Brooke, I don't know if they still here. They want to add anything, Angela?
Yeah,
yes.
Talk about what you got coming up planned as well.
Yes. So I always joke around calling all the fabulous ladies, the mommies, the hustlers, the entrepreneurs, everything and anything in between. I want you guys to, this is a way for us to pay it forward. These masterminds are so expensive, right? And so we want to take all of the knowledge, all of our experiences, bring women up, as well as communicate, help with our communities, as well as giving you guys a voice. Your story deserves to be heard how can what we've learned help you, and as well as, give back on a massive level. So we just want to have a safe place for all walks of life, all women to feel empowered and be able to grow financial wealth. And we plan on having weekly speakers, anything, CPAs, tax benefits, health. So health speakers, relationships, and financial. Overall, that's most people's top priorities. And of course, we have a Facebook group as well. We have phenomenal women from all walks of life, and we're always open for feedback. So if there are speakers that you want to have, somebody you want to nominate that's a fabulous female in your world, that her voice, her story deserves to be heard, please call, text. You got all access. There's a handful of us women. We're here for y'all.
Alexis is asking, what about men? You guys have Sharpe, Mike.
I mean,
on
hey.
the back end with us. They're the one.
Agree.
There are Elenas. There are support, right?
100%.
And Massive is fabulous. Shariah's been fabulous. Mike, they've all been super supportive. So it's win-win for everybody.
Hey, I'm comfortable to say I have married up. I don't know what you're talking about. I have married up. So, hey, I understand. Go for it, girls.
Thank you. Thank you.
Hey, we got Michael Guthrie on the house. I mean, hey, man. Good to see you, buddy.
Michael Guthrie, what's up, Michael?
I know. Without.
I think he's on mute.
Can you hear me now?
Yes, sir.
I had to push the button.
I got it. You're fancy. We got it.
No, I just
Cool,
wanted, I get your emails and I'm never available to jump on one of your webinars. So I thought I'd jump in tonight and just see what's going on over here. I'm always impressed by what you guys are putting out. You're creating quite the team.
Thank you. And you could not pick any other most technical than we went to book today.
I think he came in a little late. He can stick around for the after party for sure.
Oh, yes. Stick around. It's gonna be fun. I have 2 things I want to share. It's so cool when you look at things academically. It less takes out some of those individual bias out of the system and you objectively look at stuff. But anyways, it's really cool. All right, Mike, back to you. I want to stop sharing and
no, I think so. I think that wraps up the main agenda tonight. And thanks, everybody coming in. So as we said, we'll jump into the after party. Anybody sticking around, you got questions about what was already discussed, want to talk about with the ladies, about the ladies thing that's coming up, a little more off the record. So can do that. And we usually go into into details of things that you may not see in the main agenda part. So we never know what we may get into during the after party.
You might want to stop recording.
Well,
what happens in the after party stays in the after party, I thought.
Yeah, not exactly. We do a stop recording for the main, and then we do an after party recording.